Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers. It's Friday, April 24th, 2026, and we're looking at the data collected from yesterday, April 23rd.
And what a day it was, Ethan. Our AI sifting through social media discussions flagged a high volume of activity, with hundreds of posts across many different stocks.
Absolutely, Brooke. The market sentiment, seems like a real mixed bag. We've got some promising growth stories bubbling up, alongside some stocks that are flashing serious caution signals. It's certainly keeping us on our toes.
Well, let's dive right in. The first stock that really caught our attention with quite a bit of discussion is Reddit Inc., CTO. Our analysis has it as a stay away today, and it wasn't even on our radar previously.
That's a new one for us, and I was actually quite optimistic about it, Brooke. You see, the big news was their CTO stepping down, but then the deeper dive showed he's not actually leaving the company. He's moving into this new senior technical fellow role, which is described as the highest engineering level. That sounds like strategic talent retention to me. Plus, the new CTO coming from Meta, with all that AI and machine learning background, especially in scaling video, that's huge for Reddit's future, considering users are already excited about potential app improvements and AI moderation. I think that shows real growth potential.
I hear you, Ethan, and that sounds great on paper, really. But when I look at the KPIs, it's a much different story. Reddit's price-to-earnings ratio is an astronomical 244.75. That, combined with a very low earnings per share of 0.08 and frankly only modest revenue growth of 7.3%, suggests the market has already priced in massive future success. Any deviation from those lofty expectations could mean significant downside. And let's not overlook the debt-to-equity ratio of nearly 110. That's a lot of financial leverage, making it sensitive to any missteps in this new strategic direction.
But the insiders, Brooke, we saw strong bullish signals from company insiders, a significant net purchase of shares, indicating confidence from those who know the company best. Doesn't that suggest they believe these new leadership moves will translate into stronger financials?
It's a compelling point, Ethan, and it does have the potential to change those KPIs long term. If the new leadership can truly leverage AI and improve the platform effectively, we could see revenue and EPS climb, bringing that PE ratio down to a more sustainable level. But currently, the valuation is incredibly stretched, and the financial leverage is concerning. For now, given the extreme valuation based largely on future speculation, our AI-generated insight suggests it's a stay away from CTO. The risk simply outweighs the current fundamental rewards.
Fair enough, Brooke. Always good to have that dose of reality. Next up, it's a familiar face, Avis Budget Group, KAR. This stock was quite the talk of the town again yesterday.
And for all the wrong reasons, it seems, Ethan. The sentiment was overwhelmingly garish, confirming our previous stay-away rating from yesterday. Users were discussing KAR crashes and brutal drop-offs, with many celebrating significant gains from put options. The phrase, "the squeeze has squoze," was a popular sentiment, indicating the end of any previous upward momentum.
Well, while the overall chatter was certainly negative, and yes, the stock has taken a hit from its 52-week high, there's a powerful counter-narrative here. We've seen absolutely massive insider buying for KAR over the last 6 months, over 727% of total insider shares held. That's an incredibly bullish signal from those closest to the company. It suggests they believe the stock is deeply undervalued after this recent correction, and that a turnaround is imminent, especially with their upcoming earnings report on April 29th.
I appreciate the optimism, Ethan, but the fundamentals are still screaming red flags. We're looking at a deeply negative net profit margin, negative earnings per share of negative 25.25, and a truly concerning negative price-to-book ratio. That means liabilities are outweighing assets, indicating severe financial distress. Plus, the news headlines are pretty stark. Avis stock is plummeting after a chaotic week, and mentions of short squeeze fades as delusion risk takes center stage. While insider buying is a strong signal, it's not enough to overcome such profound underlying financial weakness for the average investor right now. The volatility with a beta near 2 just adds to the risk.
So you're saying that despite insiders pouring money in, the current picture is too risky?
Precisely. The drastic drop from its 52-week high, coupled with consistent unprofitability and that negative price-to-book ratio, means it's still fundamentally a high-risk proposition. The insider confidence could hint at a future turnaround, and that upcoming earnings report will be crucial. But until we see concrete improvements in those core financial health indicators, it remains a stay away for KAR. We haven't seen enough to upgrade our rating from yesterday.
All right, let's shift gears to something a bit more positive, shall we? Intel was a major discussion point, and this one looks pretty good.
I'm ready to be impressed, Ethan. Intel has been a mixed bag for us recently, if you remember, with quite a few stay-away ratings over the past year. In fact, our last recommendation was a buy on April 14th, so let's see if that holds.
Well, it absolutely does. User sentiment was strongly bullish for Intel, largely thanks to crushing their Q1 earnings and revenue estimates. The stock, jumped significantly after the results were announced, with some users even regretting selling early. This isn't just a fleeting moment. It signals a big shift from Intel's historical earnings performance. The narrative is that the CPU has found its way to the AI boom, and that AI-driven demand, particularly for server CPUs, is fueling this growth. HSBC even re-rated them. That's solid growth potential. It certainly sounds promising, Ethan. And I'll admit, the latest news about topping Q1 earnings and revenue estimates is a strong positive catalyst that clearly influenced a recent jump in stock price, pushing it closer to its 52-week high. However, we still have to acknowledge that some of the trailing financial KPIs, like negative revenue growth, net profit margin, and earnings per share, do reflect past struggles. While these recent Q1 results should improve those metrics going forward, they haven't yet. But the market is forward-looking, Brooke, and those Q1 results, coupled with significant insider buying we've seen, are strong indicators that Intel is turning the corner and capitalizing on the AI opportunity. The momentum is clearly there. Indeed, the price-to-book ratio, just under 3, suggests it's not excessively overvalued on its assets, especially with this renewed focus. Given the overwhelming positive market reaction to the earnings speed, the strong insider confidence, and the clear tailwind from AI-driven demand, this is a definite improvement for Intel. It confirms our prior upgrade, and for today, we're keeping Intel KAR as a buy. The recent earnings have the potential to significantly improve the lagging KPIs in the near future.
All right, team, let's wrap up today's hunt with a quick recap. Investigate as buy. Intel, KAR. Investigate as cautious buy. None. Investigate as speculative gamble. Reddit Inc., CTO.
And that brings us to the end of another episode of the Daily Hunt for Multibaggers. Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for joining us, and we'll catch you on the next hunt.